Hey, listeners, are you ready to take control of your car buying experience and make smart financial decisions? Introducing the Ultimate Auto Finance Guide, your go to resource for navigating the complex world of auto finance. Whether you're a first time buyer or looking to refinance, this guide has all the tips, tricks, and insider knowledge you need to secure the best deal. Don't miss out on this opportunity to empower yourself and drive away with confidence. Head over to www.ultimateautofinanceguide.com now and grab your digital copy. Trust me, it's the smartest investment you'll make before buying your next car. Welcome back to Drive to Success Mastering Auto Finance, your go-to podcast for everything related to auto finance. I'm John Lewis, and today we're diving into a topic that has a big impact on the rates you pay when financing a vehicle, but may seem like a mystery to many: the 5-year Treasury rate. How does it affect auto loan rates? And why should you, as a consumer or a professional in the auto finance world, care? Well, buckle up because today we're breaking it all down in clear, simple terms. First things first, what exactly is the 5-year Treasury rate? You may have heard about it in the financial news or seen it fluctuate, but how does it work? Well, the 5-year Treasury rate represents the interest the U.S. government pays to borrow money for the 5 years. Essentially, it's a risk-free investment for those who buy Treasury securities like bonds. Why risk-free? Because it's backed by the full faith and credit of the U.S. government, meaning it's about as safe as an investment as you can get. So lenders in the auto industry look to this rate as a benchmark when setting their own rates. If you're borrowing money to buy a car, your lender is taking more risk than someone lending money to the government, right? So lenders take that risk-free Treasury rate and add something called a spread to cover the risk they face. Let's break that down a little more. Lenders use the 5-year Treasury rate as a kind of baseline. If the Treasury rate is, let's say, 3%, and you're borrowing to buy a car, your lender is not going to charge you that same 3%. They'll add a spread to account for risk, like you might default on the loan. The value of the car might depreciate faster than expected, or simply the general risk associated with lending to consumers versus the government. The amount of the spread depends on several factors such as your credit score, the loan term, and economic conditions. If you have excellent credit, you might get a smaller spread added to that Treasury rate. On the flip side, if your credit is less than stellar, the spread gets bigger, meaning higher rates for you. Now let's talk about what drives the 5-year Treasury rate itself. Several factors come into play here, but two of the biggest are inflation and Federal Reserve policies. If inflation is rising, the Treasury yield tends to go up. Why? Investors demand higher returns because their money is worth less in the future due to inflation. So when Treasury yields increase, auto rates typically follow suit, making borrowing more expensive. The Federal Reserve plays a big role in this too. When the Fed raises interest rates to control inflation, Treasury yields go up. When they lower rates to stimulate the economy, Treasury yields go down, and so do auto loan rates. As a borrower, this means when inflation is rising or the Fed is increasing the rates, you can expect to pay more on your auto loan. Okay, so we've covered what the 5-year Treasury rate is and how it works as a benchmark for auto loans, but what does this mean for you as a borrower? When the 5-year Treasury rate rises, auto loan rates typically go up. This means that if you're shopping for a car, you might face higher monthly payments or need to borrow less to stay within your budget. For example, let's say the Treasury rate jumps from 2 to 3%. A lender who's offering a 5% auto loan interest rate might now offer 6%. That might not seem like a huge difference, but on a $25,000 loan over 5 years, that rate increase could add hundreds of thousands of dollars in interest over the life of the loan. Now, if the Treasury rate drops, your borrowing costs go down. So if you're thinking about financing a vehicle, keeping an eye on Treasury yields might help you time your purchase to get your better deal. Of course, the 5-year Treasury rate isn't the only factor at play here. Auto loan rates are also influenced by dealer promotions. Sometimes dealers or manufacturers offer 0% financing to incentivize sales. These offers may have nothing to do with the Treasury rate and more to do with boosting sales of certain models. And then there's lender competition. Different banks, credit unions, and finance companies may offer varying rates based on how competitive they want to be in the market. If competition is high, you might get a lower rate even if the Treasury yields are rising. And then you have loan term. A loan term might mean a higher interest rate because the lender is taking on more risk over a longer period. So while the 5-year Treasury rate sets a benchmark, there's still room for negotiation and factors you can control, like shopping around for the best rate or improving your credit score. To wrap things up, the 5-year Treasury rate is a key piece of the puzzle when it comes to setting auto loan rates. As that rate moves up or down, it directly affects the cost of financing a car. However, you're not completely at the mercy of Treasury yields. Factors like your credit score, the loan term, and even special promotions can all impact the rate you'll pay. So the next time you're considering financing a vehicle, keep an eye on economic indicators like the 5-year Treasury rate. And don't forget to shop around for the best deal. Every percentage point counts when it comes to saving money on your auto loan. Thanks for tuning in to this episode of Drive to Success Mastering Auto Finance. If you found this helpful, don't forget to share this episode with anyone you know who's thinking about financing a car. Until next time, I'm John Lewis, and remember, knowledge is your best tool when it comes to mastering auto finance.
Rolling down the avenue to a jazzy beat, following that rhythm, life's a one-way street. Chasing dreams with passion, every mile's a goal. In the world of finance, stories to be told. Catching the horizon with a soulful groove. Navigating numbers, got nothing to lose. Every calculation, every deal we sway. In the realm of autos, we find our way. Drive to success, we're mastering the art. Through the lanes of finance, we set apart. Jazz and soul, where the numbers align. Make your journey smooth with wisdom divine. Hit the keys of knowledge, let the insight play. From leases to purchases, every savvy way. Revving up those engines, zeros turn to ones. In the studio of life like morning sun. Feel the soul, embrace the jazz. In the auto world, let's razzmatazz. Financial gears shifting smooth and slick. In the podcast lane, we find the tricks. Cruising through the jargon, ain't no mystery. Unlocking all the secrets in auto history. Low ones and rates, they glisten like the stars. Drive the distance, no matter how far.
Thanks for sticking around until the end. Before we go, if you're in the market for a new or used car or even thinking about it, you must check out Drive to Success, the Ultimate Auto Finance Guide. It's packed with strategies to help you navigate the tricky world of auto financing, avoid costly mistakes, and get the best deal possible. Head over to Amazon and grab your copy today. Just search for Drive to Success, the Ultimate Auto Finance Guide, or use the link in our show notes. Take control of your car buying experience and drive away with confidence.